Welcome to the Explainer. Today, we're laying the absolute groundwork for your understanding of the modern corporate balance sheet. We are unpacking the P&J Group Business Cycle Advisory Handbook. Specifically, we're diving into the Cycle '05 framework. Our goal here? Setting the stage so you can totally master long-lived and deferred assets. Whether we're talking about the heavy physical machinery a company uses every single day, or those invisible assets that are actually driving their true market value, we're going to break down exactly how they're accounted for and managed. So, here is our roadmap for today's explainer. 1. The rise of intangible assets. 2. One rule for every asset. 3. The 3 asset buckets. And finally, 4. Your course roadmap. All right, let's jump right into section 1. The rise of intangible assets. We are currently witnessing a massive, fundamental shift in modern business. Think about a traditional company for a second. When you hear the word asset, what pops into your head? You probably picture sprawling factories, heavy machinery, maybe a fleet of delivery trucks, right? Well, that's the old world. Which brings us to a really crucial question. Why did version 3 of the Cycle '05 Handbook expand so significantly to include an entirely new framework? The answer to that lies in this exact contrast. Just compare traditional physical assets, property and plant, to intangible assets, like global brands, proprietary tech, and customer relationships. The modern balance sheet is now absolutely dominated by these invisible intangibles. The days where a company's worth was strictly tied to its physical real estate, those days are over. Today, a company's true worth often lies in things you literally cannot touch, and that is exactly why the entire handbook framework had to be rewritten from the ground up. Because of this massive shift, the stakes are incredibly high. The source actually gives us this stark, almost chilling warning. Getting intangible accounting wrong distorts asset values, amortization expense, and impairment testing for years. Notice that phrase, for years. If you mess up the math on these invisible assets on day one, it's not just a minor hiccup. You wreck the books for the foreseeable future. And honestly, why is it so easy to get wrong? Well, because unlike buying a physical truck where you just look at a clear purchase invoice, these invisible assets require highly subjective judgment calls. You have to estimate useful lives, you have to somehow determine fair value right at the exact moment of acquisition, and on top of that, you have to constantly monitor for impairment triggers to see if the asset has lost value. Handling all of this has truly become the highest risk tightrope walk in the entire accounting cycle. Which leads us perfectly into section 2, one rule for every asset. Now, if all that talk about high-risk judgment calls had you sweating a bit, let's take a collective breath. I'm going to offer you some massive cognitive relief here. No matter how wildly complicated the balance sheet gets, it all comes back to one foundational definition. An asset is simply a resource that provides future economic benefit. That's it. It completely disregards whether the asset is a sprawling physical warehouse, a digital patent, or a prepaid insurance policy. The source changes, sure, but the fundamental definition remains exactly the same everywhere. Because of that, we have this universal 3-step mantra that every single asset must undergo during its life cycle. Step 1, you capitalize, meaning you record the cost or fair value when you first acquire it. Step 2, you allocate or test. You systematically allocate its cost over its useful life through depreciation or amortization, or if it lives forever, you test it for impairment. And finally, step 3, you de-recognize. You pull it off the books when the benefit is entirely consumed or the asset is sold. Every asset, physical or invisible, follows this exact 3-step cycle. Learn this, and you literally hold the master key. Okay, let's get into the specifics with section 3, the 3 asset buckets. To make this incredibly complex universe manageable, the handbook neatly categorizes everything into 3 buckets. Here is bucket 1. Tangible, long-lived assets. These are your physical heavyweights. You've got property, plants, and equipment, which is systematically depreciated over time, with the exception of land, of course. Then you have natural resources, which follow a very specific rule. They're depleted, not depreciated. That's because their value is quite literally being extracted from the earth over time. Then we slide over to bucket 2, which deals entirely with intangible assets. How we treat these depends completely on their lifespan. So if it's finite-lived, like a patent, it gets amortized over its useful life. If it's indefinite-lived, like a massive global trademark, we don't amortize it at all. Instead, we test it annually for impairment. And then there's goodwill, which arises during business acquisitions. It's never amortized, but it absolutely must undergo a strict annual impairment test. I really want to zoom in on goodwill for a second, because it's a totally unique beast. Goodwill is a residual premium paid in an acquisition. It is not an identifiable resource on its own. You can't just put goodwill in a box and sell it to someone else. It's simply the extra amount a company pays over the fair value of the assets when they're buying another business. Because it's a residual premium, it gets its own separate treatment. It is never, ever amortized, and it demands rigorous annual impairment testing at the reporting unit level. Rounding out our framework, we have the third bucket, deferred costs. This essentially covers costs that we pay in advance. Think prepaid expenses, right-of-use lease assets, where you're securing the right to use a leased property, capitalized software development costs, and leasehold improvements. For all of these, the costs are held on the balance sheet and recognized as expenses gradually. The whole idea is to match the timeline of when the benefit is physically or economically consumed. All right, let's map out your next steps in Section 4, your course roadmap. Now that you have the macro perspective, here's the exact sequence you'll be following for your learning journey. You're currently in Step 1, the foundation. Next, you'll tackle the full life cycle of PP&E. Then you'll move right through prepaid expenses, intangibles, and a dedicated section just on goodwill. From there, you'll dive into software and R&D, learn the verification processes, and wrap the whole thing up with advisory application and KPIs. It's a highly logical, step-by-step climb to total mastery. Now, for the sake of your time, let's quickly cover what you don't need to worry about right now. A few narrower topics have an excluded scope, mostly because they only apply to a much smaller subset of clients. So, asset retirement obligations, natural resource depletion, non-monetary exchanges, and sale-leasebacks, those are not covered in this core explainer sequence. But if you ever do need them, you have the exact stage numbers right there for reference. Before we wrap up, I really want to hammer home one core theme. The absolute deepest focus of your upcoming journey goes directly to Sections 4 and 5. Intangibles and goodwill get outsized attention precisely because they represent the riskiest, most incredibly complex area of the balance sheet today. Getting these right, that's what separates an average practitioner from a true advisory expert. Which brings us to the end of this foundational explainer. But I want to leave you with a final, somewhat provocative thought to chew on before you start the next module. If an invisible asset, something you literally cannot see, touch, or hold, is what actually drives your company's true value in the modern market, are you truly prepared to make the high-stakes judgment calls required to protect it? Keep that question in the back of your mind as you move forward. Thanks so much for joining me on this explainer, and I can't wait to see you dive into the rest of the course.